All right, well, welcome to the Beginner and Small Account Trading Group slash Roundtable for Thursday, May 5th, 2022. I'm Tim, and we have a special guest speaker, Carl Jorgensen, here today to tell us how he trades options. I met Carl 6 or 7 years ago at a local options group for a few times, and I've been, following along with him a bit ever since, and he's been trading for a long time, and is going to talk to us today. So before I get going on that, let me do the usual disclaimer and all that other stuff. Just for fun, the picture you're looking at is a picture I took from flying over the tulip fields in Waconner, Washington. They're famous for that every year, and hundreds, thousands of people go up. The freeway gets jammed full because everybody wants to go up and see the tulip fields. So I went up and flew over them so I didn't have to go through the traffic jam. And this is one of the pictures of one of the tulip fields up there. Okay, let me do the disclaimer and then we can get started. Yeah, there it goes. Okay. Disclosure is that Airmere is not a broker-dealer or securities investment advisor. I am also a broker-dealer or securities investment advisor, and so there are no trade recommendations made during this session. Everything you see and hear here today is for educational purposes only. This information neither is nor should be construed as an offer or a solicitation of offer to buy or sell securities. You shall be fully responsible for any investment decision you make, and such decisions will be based solely on your evaluation of circumstances, investment objectives, risk tolerance, and liquidity needs. Options involve risks and are not suitable for all investors. You always trade at your own risk, and past performance is not indicative of future results. And here's page 2 of the disclosure. You can pause the recording and read the rest of the fine print in the disclosure, which is also what you agree to when you log into the Airmere site. Okay, that is that. Just a brief comment to lead into Carl here. We had SPX down 153 points today. It had been down as much as 199 or 98 or something like that. It gapped down and went down, gap and go, I call it. And as far as I can tell, it's interest rate jitters and interest rate markets up today and all that. But we had a super jump up yesterday and more than that back down today. So the market is very volatile. VIX was up, and we'll see what happens from here and how we can respond to it. I personally don't have anything on except all my usual covered calls, and in the down market, covered calls they're great because the premium wastes away, and that's what's happening. And so my covered calls are all in good shape, and I didn't have to make any trades at all today in such a down market. So of course, the adverse to the downside, and net value is down a bit because the stocks all went down, but the calls didn't have to be adjusted. Okay, so I don't want to talk too much longer. I want to get right into Carl's thing here. And Carl, thank you for joining us today. I think you're here and you can hear us.
Yes, I'm here.
Yeah. I think everybody might have seen the bio that we had on you, but you might tell us a little bit about yourself and get going.
Very good. Well, let me see if I can share my screen and I'll get going.
Oh yeah, I've stopped my share first and then you should be able to share. And as we go through here, I will watch the questions and chat box, and at some point we'll pause and see if there's any questions. And
very good.
I'll help you with that. Yeah. I see your screen.
Okay, well, let's get going then. I tend to prepare a little bit more material than we have time for. It's just a habit of mine to be prepared, So I'm going to go through it as quickly as I can, but I also, I'm willing to stay as long as it takes and offer to answer any and all questions. I'd like to kind of do that in the last 5 or 10 minutes if possible. So if you've got a question, jot it down and you'll get a chance to ask towards the end. And also, I understand this is being recorded. So if you're not under pressure to take copious notes, you can relax and try to absorb the material. And even if I do go fast through a number of screens, the playback will give you an opportunity to dig deeper if there's something that you felt you missed or whatever. So having said that, let's get going here. Let's see if I've got my, Okay. So pretty much I need to give you a warning just from the standpoint of all of the information and material and examples that are used in this presentation are solely for educational purposes and in no way represent investment advice or recommendation to buy or sell any stocks, options, commodities, futures, or any other financial instrument. Carl Jorgensen and our trade objectives and our subsidiaries or affiliates or representatives are not engaged in financial or other professional services. The student is encouraged to seek independent advice from a competent professional in the financial, legal, tax, or other expert as assistance is desired or required. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past results are not necessarily indicative of future results. Having said that, who the heck am I? Well, basically, I had been introduced and started trading and learning about options back in '95. And things went well. I'll gonna go in a little more detail in the next couple minutes, but I had some success, and then I left the world of employment and became a full-time trader in 2002. So since the last 20 years, my primary income is trading. I spent almost 2 years as a registered trader at the Pacific Coast Options Exchange. That was the options exchange that was in San Francisco. And I was a prop firm trader. I traded both on and off floor, though most of the time was off floor. And that was a great experience to learn from other people who had survived years of learning how to play the game. A couple years later, I began teaching and speaking at seminars or at local groups. And then I also began coaching students individually. And lately, the last 4 or 5 years, I've chaired the Seattle chapter of the CMT. That's a picture of my ugliness. Some of you have met me face to face. Some may not have. So basically, I'm going to try to give you a real quick story of what got me to where I'm at here and why. It'll make a little more sense as we go deeper. First, I had a financial planner recommend to me, well, why don't you learn about options? Okay, so I did. I read all kinds of books, went to seminars, and I even traded occasionally a small size. And then as I learned more, this was again as a full-time employee, I had a situation where as an executive of a company that we took public, I had all kinds of restrictions on what I could and could not do, but I had a concentrated position of shares in my employer's company. So my objective was to diversify and slowly over time sell my shares and free up that cash to invest in other and broader areas. So that led to writing a trading plan that met the criteria of the IRS, the SEC, the board of directors, our lawyers, etc. So as an executive, the written plan was executed by my broker once that plan was approved. And the objective of that trading plan was to sell covered calls. And as any of those were exercised, I was backing out of my concentrated position. So the purpose was to sell stock in my employers with my holdings. I actually did very well for 2 or 3 years doing that, and even made more doing that than my 6-figure income as an employee. So with that success, I felt more comfortable to leave the world of employment and go out on my own as a full-time trader. And that was in 2002. But the next year or two, I had very inconsistent results and struggled and tried all kinds of strategies, methods, etc., with inconsistent results. I had wins and losses, but I really wasn't getting anywhere. So I wanted to understand why was that case. Something that happened during this time that actually kicked me in the butt to get me to figure things out was I went to a seminar taught by reputable folks. I won't mention Tom Sosnoff and Thinkorswim and JJ and Don Kaufman and all those people, but this is, well, geez, 17, 18, maybe 19 years ago. They did a 3-day seminar. It was pretty much focused mainly on option selling strategies of vertical spreads, diagonal spreads, all kinds of different spreads where you're primarily your objective is collecting a premium from the options you sold, and you hedged your risk by the options you bought. Anyhow, during the course of the 3-day seminar, the class did 10 trades, and you could participate in those trades if you wanted to or not. I participated in all 10 trades. Out of those 10 trades, all of them sold strikes that were at least 1 standard deviation out of the market. So logic kind of told me of my expectations were, well, maybe 6 to 7 out of those 10 trades should make money. Being 1 standard deviation, that's kind of the normal distribution, right? Well, not 1 single trade made money. All 10 were losers. So that kind of made me go, huh, what's going on? Why was that the case? And I think Tom Sosnoff and others were a little embarrassed, and a couple months later came back and did another 3-day seminar, teaching pretty much the same material. And we did 10 trades. And out of those 10 trades in the second seminar, how many made money? 1. So this caused me to go, what's going on here? These guys are the experts. What's going on here? So don't take me wrong. I'm not saying what they taught was good or bad. I'm just saying this motivated me to answer those questions. So I dug much deeper to analyze, well, what was going on here? Why did they work or not work? What was going on in the markets? What was the pros and cons of the strategy, the probabilities, expectancy, and also what were my beliefs and my goals too, trading. So this sent me down the rabbit hole, okay? And basically I was searching for my edge. That's another way of stating it. And one dimension of that was really learning a lot more about technical analysis. So I dug deep into studying chart reading and a whole plethora of things in that dimension. And then I also looked into how to optimize what strategy is the best fit for an opportunity in the market, and the decisions on picking the strike and expiration on all of that. And then also there was an analysis of my beliefs about the markets and what market behaviors did or did not agree to my beliefs. And in some cases, I had to change my beliefs. Probably the biggest single point of this journey was when I was successful doing covered calls as an employee, I wasn't messing around with my plan. It was written, approved, and my broker executed it. And I couldn't change it because we went through a whole legal process to get it approved, because I was an executive and an insider and I couldn't change it. Well, why did I have success and consistent success then and not now? I didn't have a written plan. Duh, I had procrastinated and not really focused on identifying my strategy and tactics and how I'm going to implement it and measure it, etc. So probably that's the one biggest thing that was missing when I was struggling, is not having a written trading plan. And part of that written plan is what data do I collect and how do I use that data to make performance improvements? And probably most importantly was sticking to the plan. I didn't change the plan unless the data proved that it was justified. And then as I did those things, my results started becoming consistent. Duh, consistent behavior, consistent results, okay? So that's just the good and bad. I'm embarrassed that it took me a couple years to get my act together, but that was the real world. And, you know, having met and worked with a lot of traders over the last 10, 15 years, that's not an uncommon journey to go through. So when I look at options trading, there's really kind of breaks down to three main styles. Either you're using options as a hedging tool, meaning maybe you're a fund manager or you're holding a portfolio and assets. So you're buying insurance to protect those from loss. A second strategy I'll call a speculator, meaning you're taking a directional opinion about the markets, even if the direction is horizontal, but you're taking a directional opinion and you're betting on that, and you're using options as a leverage tool. You could do that with futures as well. And then three is the premium seller. So that's basically you're providing insurance. You're being paid to take on risk in the market. So each one of those strategies, there's nothing wrong with any of them. I've used all of them. And each one has its own pros and cons and nature of its beast, and can be very successful when implemented wisely. The majority of my trading over the last several years has really been that of a speculator. And we'll get into details of my trading style as we go. Some common errors that are really important to understand is, and this is common of speculator type options traders, of buying out of the money options because they're cheap and then hoping they'll explode in value, because you have the potential for very high gains if you're right, but people don't usually realize that the odds of that happening are extremely low. So if you're buying out of the money options, you might only have one winner out of 10 or 20, and that one may or may not earn you enough to make up for all the losses. Another common error that I've seen with premium seller type strategies is that you're collecting lots and lots of small gains, but then one big loss can give it all back. There's plenty of traders and even firms that did well for several years, and then one big loss event wiped out their account. And there's plenty of examples of that happening. Now, it doesn't mean that that happens to everyone who's a premium seller. Of course not, but that is a common error and risk. And then thirdly, I have here is trying to follow someone else's system. Someone else developed their own system, and it probably doesn't fit your beliefs or observations about the markets. These days, there's just tons and tons of free information out on YouTube and other resources, but the vast majority of it looks like marketing stuff to me. It makes me kind of sick because they focus on peddling hope of potential gains and winners, and they usually either ignore or underplay the probabilities of losses. Again, any strategy can be made to work, but you've got to look at the whole picture to be successful in the long run. A few more key errors here I wanted to mention, because we're going to address them as we move forward here, is not matching the appropriate option strategy to the opportunity that you've identified. And we'll get into what the three opinions are that help direct that and how to optimize that. Not efficiently selecting either the strikes or the expiration series that fits your strategy or objectives. Thirdly is ignoring the slippage, inefficiency, or probabilities, or the Greeks in constructing your position. And then fourthly, trading positions that are too big and not sized for a sound risk management position. A lot of new traders or small account traders that I've come across don't realize how important position sizing and risk management is, and it's a very common mistake to, as you're learning, or as your account is small, taking on too much of a risk, and that just makes the odds much higher that you could easily blow out your account, which is not what anyone wants to do. And what typically causes those negative results are the distribution in the markets are not really modeled well with the normal distribution curve. I'm not going to get into statistics heavily here, other than when you look at the real market data, you see far bigger moves than what the normal distribution model or even the Black-Scholes model predicts. And most of those bigger moves, more often than predicted, happen on the bearish or negative side. I don't need to bring that up with today's example. Today we saw either the biggest move all year in the Dow, or we saw the biggest range move or second biggest range move in the NASDAQ and S&P this year, just today. Now, how often do these fat tails happen? Well, I actually keep track of the weekly expected move on the S&P, and that's determined after the close of the market each Friday, looking at the options prices for their expiration 1 week into the future. And that prices of one standard deviation move. So having done this for several years, here's the data as of now in 2022. If you looked at the data to see on January 21, the S&P closed that week at 43.97, but the expected move for that week was plus or minus $85, which would have been a one standard deviation move down would have been 45.77, or a one standard deviation up would have been 47.48. Well, what we saw wasn't either of those, was it? What we saw on that week was 43.97. Well, that not only was, let's see if I can get, okay, there it is. That ended up being, if we looked at 3 times the one standard deviation move, that would have been a target of 44.06. And we actually closed below that by another 6-8 points. So on January 21st, we saw over a 3 standard deviation move in the S&P. That was January of this year. What else have we seen? Well, the last 3 weeks, we saw a close each and every week below the one standard deviation move for that week. And the standard deviation, the size of the expected move has grown bigger each of those weeks. You can see 4 weeks ago, it was $76. 3 weeks ago, it was $97. Last week, it was $133. And this week, it's $167. So 3 weeks in a row of closing outside the one standard deviation, that would make a pretty tough market to trade if you're an option seller. It's a heck of a great market to trade if you're an options buyer. What that means when the S&P closed outside of the expected move is that the options market were underpricing actual risk. The opinions of the options market participants underpriced the actual risk for that week. You don't know that until the week is over. Now, look at this week. We see $167 expected move, that's plus or minus from last Friday's close. Where did the market close yesterday? Yesterday, we had that rally of the last hour or so of the day after the Fed. We closed within a few cents of what? The one standard deviation move up, or 42.99. There's reasons for that, and it tends to be what hedge fund managers do and how they manage and use dynamic hedging. That's a whole nother discussion in itself. But let's move along here. I need to pick up my pace. Last year in 2021, we saw 38% of the weeks close outside of the expected move. One standard deviation would have expected only 31%. So you can see more often than expected, we saw closes even last week during that, last year, during that enormous rally last year, that we still saw closes outside of the expected range or expected move. Now, I spoke earlier about option selling, and there's a long list of firms that blew up, from long-term capital to optionsellers.com. I think that was 3 years ago. There's an infamous video of the founder of that firm crying and apologizing on a YouTube video. Karen, the super trader, she blew up her account. So there's no shortage of examples of people that are using option selling as the primary mechanism and didn't manage risk effectively. There's nothing wrong with the strategy, but there's a whole lot wrong when you fail to manage risk. Here's a quote from Van Tharp. You don't trade the markets, you only trade your beliefs about the markets. And this kind of sounds like a simple statement, but it's actually very profound when you realize how and what decisions you're making versus what the market does. So with that in mind, what are your beliefs about the markets? Are the markets random? Do you understand, or do you have an opinion about the efficient market hypothesis and its 3 forms? Do you have an opinion about fundamental analysis and the value that it might give in analyzing markets or opportunities? Technical analysis. What useful beliefs do you have about technical analysis? And then 5th, I have behavioral finance, which is kind of a newer field, but it's really looking at certain behaviors that people make consistent errors about financial decisions. And that's a whole nother field of study. The key is to know your own beliefs about these different things and about the behaviors of the markets. And why that's important is when you develop your own trading system or style, if it is in agreement with your beliefs, it's going to be far easier to have the discipline to stick to it. When you try to learn a system from someone else, it's much more difficult to be disciplined and stick to it because you didn't develop it and you probably don't know it intimately. And the classic example of the turtle traders is an example of that issue with trading a system that you did not develop but someone else did. It's very hard to follow. So the key is, I'm going to share with you today some of my beliefs, but your beliefs are very likely different. So don't take anything I say as being the truth, even though to me it is, but test it yourself. That's the best way to learn, is take something that, and I did this several times with either books I read or seminars I went to, was I don't agree with that. They're saying one thing, but my beliefs are different. Well, I go and test it and find out, gee, they were right. I have to change my beliefs. So in either case, testing it yourself is going to make it much more easier for you to have discipline and stick to your plan. Changing your beliefs if the data and observations confirm a need to do so, and then developing a trading plan that respects your beliefs. Some systems that you may develop are successful for a while. Eventually markets change character and then fail to work. Other times you may have developed a system, but it has no statistical edge, or in the long run, what we call a negative expectancy. And we're going to get into that next. A profitable system, all profitable systems have and must have a positive expectancy. And that's my goal, and should be everyone's goal. To be profitable trading is to have a positive expectancy in your system. What the heck is that? Well, here it is. Expectancy, again, this is from Dr. Van Tharp, the late Dr. Van Tharp, it's a very simple math of the probability of a win times the size of your average win. And that product, you subtract from it the probability of a loss times the average size of a loss. And if the losers are bigger than the winners, you're going to have a negative expectancy. If the winners on the whole are bigger than the losers, you're going to have a positive expectancy. It's really that simple. But I never saw anyone who implemented these ideas with options. So what did I do? Yeah, that's what I did. Another useful tool also from Van Tharp is R's and the R multiple. R just stands for risk, meaning the dollar amount at risk in a trade. And I'm using an R as a measuring tool because as my account grows or shrinks, that R number may change. But if I'm trying to evaluate the performance of a system and its expectancy, then but make it regardless of the size of my account, then R is a useful tool for measuring. So the way that's used is the net profits of a trade or loss divided by the amount risked equals the R multiple. So if you risk $200 in a trade and your profit at the end of the trade was $300, we would call that a plus 1.5 R. If you risked $200 and lost $200, we would call that a minus 1 R. And if you risked $300 and made $900, we call that a plus 3 R. So our multiples are just simply that, measuring the profits as a function or a ratio to the dollar amount risk. It's like return on risk. Here's an example of how I implement this or have changed how I implement it. So if we have a hypothetical account size of $100,000, but you could use 5,000, 10,000, 50, whatever is appropriate. My maximum risk rule per position is 2%. So I don't want to risk more than 2% of that on any one trade. So that means my R is $2,000 when my account is $100,000. So let's use a trade example. Let's say I want to buy some calls and they're trading at $5. Well, for one contract, I need to pay $500 because a contract represents 100 shares. And then how many contracts can I trade of those calls? Well, if I take my $2,000 R and divide it by $500 for one contract, I can trade 4 contracts. Then the capital required to put on that trade is $2,000. Now, what I did a year or two into my trading system was I changed this methodology so that if I take the same $5 calls, but I'm using a 50% stop loss, then the maximum exposure I have per one call contract is actually $250. So the maximum contracts I could trade in that case, where if my R is $2,000, then I can trade 8 contracts because that represents a $2,000 loss if my 50% stop is triggered. I'm, however, required to kick in $4,000 of capital required for that position. And it's the same principle if you're a stock trader. A 2% loss, you may spend $20,000 to buy 100 shares, but your risk might be at $2,000. So the capital required doesn't have to be the same number as the risk. The important thing is you use and respect your risk exposure, no more than 2%. Here's a second example, same idea, but this time we're going to use a spread. So let's say I'm doing a call credit spread where the width of the spread is $5 and the credit I'm taking in is $1. So I have $4 of risk, or one contract or one spread contract is $400. Divide the $400 into your $2,000 R value, and you can find that you can do no more than 5 contracts or 5 spreads. Again, the whole idea is to limit your risk exposure, worst case, to not lose any more than your R number that you identified. So what are my trade objectives going forward? Let's see. I want to limit my risk and my losses. I want to allow winners to grow bigger. I don't want to use spreads to cap off my wins. I want to leave them open-ended to be whatever they can be. The most important thing is to achieve a consistent positive expectancy. And I need to help do that, I need to fully understand and capitalize on my edge. Part of that is tracking performance, collecting data, and continuously improving my performance and efficiency. So I need to find an option strategy that fits my trading objectives and that fit the market conditions. These are not predictions, but they're opinions that I have about the market. So these are the three opinions I need to make or identify, and they're opinions. They're nothing more or less than that. Price, is the price going up, down, or non-trending? Where is it now? Where do I believe it's headed? And that's where I may use technical analysis to help answer those questions. Implied volatility. As an options trader, we care about, is that high or low right now? Is it increasing or decreasing? What's my opinion about implied volatility? If options are expensive, maybe I want to focus on selling options. When they're cheap, maybe I want to focus on buying options. And then thirdly, time frame. I need to have some idea of how long it might take to get there, whether that's price or implied volatility. As a stock trader, you probably only have one opinion, it's on price. But as an options trader, we really need these three opinions: price, implied volatility, and time frame, to help us decide how best to implement that. So a simple matrix of, across the top, I have low, moderate, and high volatility, or implied volatility. And on the left, I have bullish, neutral, or bearish markets. Where are we now? Well, that's probably pretty obvious for a high volatility bearish market. Sheldon Natenberg, in his book, Options, Volatility, and Pricing, published this same kind of table listing the many different option strategies that one might consider using in one of those market conditions. I'm not going to go over this in detail. Some of you may or may not have that book. I recommend it. It's not easy reading, but I think in the appendix, in the back of that book, you'll find this kind of chart. So how do we evaluate the expectancy of different option strategies? So I'm going to do some studies, and that's kind of how I make my decisions. Is I actually ask a question, go set up a study, analyze it, usually with a spreadsheet or something, to see what is the market telling me about that strategy or expectancy. So again, we're using an example in this case of a credit spread, and I'm selling about 1 week out an SPY credit spread where I'm selling the 303 strike and buying the 304 strike. And those strikes were selected because the short strike is about 1 standard deviation out of the market. The bid and the ask. I'm in the SPY, that options market is extremely tight. There's generally 1 penny to 2 pennies between the bid and ask. So I'm paying the ask and I'm selling to the bid, which should be filled immediately in that market. The credit for that spread is 17 cents, or 1 contract would be $17. The probability is actually pretty close to equal to the delta. You could, in Thinkorswim, add a column to your options chain. That's the probability of expiring in the money. That number is usually less than 1% of a difference than the delta. So the delta is close enough. You could use either one. But what we're doing is we have an 81.9% probability of keeping that credit we sold at once these options expire worthless. And then we have an 18% probability of taking a loss on it. So the max loss would be 83 cents less the commissions or fees, which is $15. So when you do the math on expectancy, you come out with a negative number of $2.62 on one spread. Well, that's not real promising. So again, you can see from the options chain that the spreads between the bid and the ask are mostly 1 cent to 2 cents. So there's no real wiggle room there. So let's do the same thing and just go further out of the money. What if we sold a spread that was about 2 standard deviations? In this case, it actually ended up being 1.9, but it's the same deal. We sell this spread, it's further out of the money, but it still has a negative expectancy once we do the math. Well, what if we use a wider spread instead of 1 strike, 2 strikes between them? Well, we still get a negative expectancy. What if we did a pair of spreads known as an iron condor? We do a put spread below the market and a call spread above the market. And hopefully, when we're lucky, both of those expire worthless, we keep the credit. Well, again, when you do the expectancy, even though 95% of the time it's going to be a winning trade, 5% of the time it could be a losing trade, and that's enough to create a negative expectancy. Surprise, surprise. Well, I started getting answers here from the simple math of why the seminar that did 10 trades lost on all of them. Well, they had a negative expectancy. Now, that does not mean that strategy is useless. I know that option selling strategies are very popular, partly because they have a high percentage of winners. What the point of this is, you're not getting a positive expectancy or no edge or advantage from the strategy itself. You can, however, implement trading strategies or conditions that can give you an edge. The edge is not coming from the option strategy, but it's coming to how you implement it. Examples of how one might implement a option selling strategy might be, am I selective on when and where? On if the implied volatility conditions are high, should I ignore that? When they're low, should I take advantage of it? Or are there technical analysis chart conditions that say this is a good time to do so? Maybe support was tested and respected, so you're going to sell a put spread below that support, or resistance was tested and respected. You might sell a call spread above that resistance, where the odds might have now shifted to be a bit in your advantage. So to implement an advantage with option selling, you've got to have something other than the strategy itself to give you an advantage or edge. Otherwise, you have a negative expectancy like we just saw in the prior 5 or 6 examples. What you find when you're developing a trading system is when you try to adjust one attribute that either relates to the size of the win or the size of the loss or the probabilities, if you try to adjust one of those, the other 2 end up are affected indirectly or directly. So whenever you test a change, you need to test the net impact of that on the entire system or strategy. With all of these examples I'm giving you, I'm encouraging you not to believe me. Not that I'm lying to you. I'm telling you exactly what I found in my own testing. But what's more powerful is for you to test your strategy yourself, calculate the expectancy, and then confirm what you believe, or maybe you might find you may have reason to change what you believe. Why risk a lot of money on a trading system that has a negative expectancy? That's what we're trying to avoid. So now let's go a little bit further. We talked about how to match your opinions to an appropriate strategy. Now let's look into optimizing the strike and expiration selections and the aspect of slippage cost, all again for the purpose of improving our expectancy and reducing the risks. Slippage cost, basically that's the cost to get in. If we got in and immediately out of a trade, there's going to be some cost. Usually it's contained in the bid-ask spread for the round trip. So if we're paying the ask and selling to the bid, we've got a little bit of slippage there. Commissions and fees. Well, with commissions being zeroed out, there still are some fees. With options, it's probably like, what, 65 cents a contract, and maybe 2 or 3 cents for the exchange or the OCC. But even though those numbers might be small, they still matter and can add up. So let's evaluate that. Here's an options train from Caterpillar from 3 years ago, and we're going to use it to both do an entry and exit as if we're doing the entry and exit just 1 second after the other. Get in, get out. What's the cost disadvantage of doing so? Okay. So what we did is we did 3 different strategies. We did a long at the money call. We did a bull call spread, and we did a call butterfly. And with each of them, we measured the slippage, and it's no surprise to find out that the greatest slippage was with the butterfly, and the least slippage was with the long calls. And it's pretty simple to understand why. Is the more legs or more contracts total, the more slippage. And the reason why slippage is important is that's the disadvantage you're giving yourself at the moment you enter a new position. You have to, the market needs to move enough to make back your slippage before you get the first penny of profits. So the bigger your disadvantage, the further the market's got to move for you to break even, let alone make money. So those are slippage evaluation numbers. The more, again, the more legs or more components, the more to overcome. I'm not saying don't trade it or it's not profitable. I'm just saying realize the cost of implementing it. Okay, let's look at the strike and strike selections. I'm going to just focus on if you're buying long options, whether it's calls or puts. And the way we do this is we capture an options chain for a typical trade at the moment of entry. And then in this case, it was about a week later, we do the same thing, capture the options chain at the moment of exit. And then we do the same theoretical trade multiple different ways, with the only difference being the strike selection. So here we have an evaluation exactly that. And the underlying was Lockheed. The underlying price at the time of entry was 146.88. A week later at the time of exit, it was 153.86. So there was about a $7 move in the underlying. We used out of the money calls, the 155 strike. We used a little bit out of the money calls, the 150 strike. We used a little bit in the money calls with the 145, the 140, and the 135. You see across the line at that red arrow there. So those are the 5 strikes we selected. And we're going to do the same trade with those 5 different contracts. The delta at the time of entry is right below it there of 0.06, 0.24, 0.65, 0.87, or 0.96. And we had 11 days till expiration on this example. The key thing here is we need to size each of these 5 different positions so that they're equalized in risk. And the way we do that is we had $1,210 or $1,220, whatever was the risk amount at that time. And we can only buy enough contracts to estimate that risk. So in the case of the deep out of the money, we could buy 60 contracts. A little bit out of the money, 18 contracts. A little bit in the money, 4 contracts. And then the further in the money was 1 contract, because it was, if we did 2 contracts, it would be $1,500, which took us beyond our risk limits. And then the 5th column, we bought 1 contract for $1,210. So now all the numbers are here. I'm not going to go through them other than look at the total slippage. Which of these 5 positions has the most slippage to overcome? The deep out of the monies had $900 of slippage. And this is with free commissions, okay? It's because you're doing 60 contracts in and 60 contracts out. Now, at the bottom, we see an expectancy. And what that is the profit, but it's also the profit. So in this case here, we had a $6,000 profit, but the probability of that happening is only 24%, which means the expectancy was 1440. Versus right next to it, we have the example with the in the money where the profit was 1295, but the probability is 65%, which that product computes a 1491 expectancy. So the trade with the greatest expectancy was very much driven by the fact that you used in the money options, to choose a delta of 65 in this case. So after having done many evaluations just like this of different trades and different options chains and underlyings, the sweet spot for expectancy is basically in that 55 to 65 delta range. So that's how I select my strikes. Another aspect to keep in mind about options are there's intrinsic and extrinsic value. And the intrinsic value is very black and white defined. It's the difference between the in-the-money strike price and the current price of the underlying. That's simple math. That doesn't change other than when the underlying changes. On the other half of value, we have the extrinsic value in yellow, and I call that squishy, meaning that changes and can change dramatically as implied volatility increases and decreases, but also as time and time decay goes on and so forth. So the key to this understanding of using options is when we're selecting a somewhat in the money option, at least half or maybe more than half of its value is defined by the intrinsic value, and less than that is squishy with the extrinsic value. And the extrinsic value is the part that gets impacted as volatility changes or time decays. So what that does is by trading in the money options, we actually minimize dramatically theta decay and vega exposure. And that's something that a lot of books and seminars fail to mention about one of the features of buying in the money options, but an important key to how I operate. The next decision is days till expiration, and how do I find the most effective or appropriate expiration series to use? Well, back when I started doing this, monthly was the only choice, and it was the front month usually, as long as I had, let's say, 2 weeks till expiration. Now with weeklies, we have tons of choices, but basically when I evaluate my actual trades and the statistics, I find that the average duration of my trades is between 1 to 2 weeks. So I don't really need to go further out than that. And by staying closer to that two-week target, I actually get a maximum impact of delta and gamma and minimize theta. So how do I find my trading opportunities? Well, basically, I'm looking for trending stocks that are either beginning a new trend or breaking out, or resuming an existing trend where they trended for a while, paused, and then resumed their trend. Let me back up. I use a top-down market analysis to very quickly, meaning in a few seconds, identify the strongest stocks and the strongest sectors for potential bullish positions. Or if I'm looking for a bearish position, I can look for the weakest stocks in the weakest sectors. And I'm going to show you how I do that. Also, I do a weekly publication for free. It's available at my website. I'll mention that later. That is actually structured the same way of this top-down market analysis. And you're free to download that each week if you want. The key here is to set up your tools on your chart package to be very efficient so you can go through this process very quickly. So I have a watch list created that I call Carl's sectors, where I think I have 17 or 18 different sectors, and each one has an ETF. There's a little bit of overlap between some of these sectors, but I also have it set up to sort by the percent change that day. So all I do is look at this watch list, and immediately, if I'm looking for bullish opportunities, I see the strongest sector is the XLE or energy. If I'm looking for bearish opportunities, I can see SOX, so the semiconductor, is the weakest at this moment in time. Having done that, I next go to a watch list for that sector, in this case, XLE, and what was the strongest stock in that sector. So I have then, I'm going to look at the top 3 or 4 names on this list on the charts. How do I do that? Well, I link them, which is a nice feature, by selecting a link channel, in this case channel 2, on both my chart and the watch list. So all I have to do is click on that symbol and the chart automatically pops up. That's a pretty efficient use of time. So I can go through the top two or 3 or 4 charts in just a matter of a couple seconds. So in this case, you can see that I actually had previously drawn a line at the 35.75 level. And we're going to go through a couple sample trades here in a few minutes. Hopefully I need to pick up the pace a little bit, but that's a very efficient way to use watch list and your search process, where you can do that in a few seconds. Why I do that is one of my beliefs, that most stocks move with the overall market trend and their sector's trend. And only a few stocks usually are doing their own thing. I call them outliers, and they might be moving in a way that seems to ignore the trend of the market or the sector. And then I need to update my list maybe once or twice a year. So what is my trading style? Basically, I'm a swing trader. Typical positions last 2 to 3 days to 2 to 3 weeks. I'm taking directional opinion. I typically do about 120 to 150 trades a year on average. They're all trend following in nature, and I'm only trading the most liquid stock, the 100 to 150 most liquid stocks with the most liquid options. So as you saw, slippage and efficiency is important, and you find tighter spreads between the bid-ask with the most liquid instruments. Occasionally I trade ETFs, but that's rare. And the most important thing is I've had 17 years now of consistently profitable performance with this trading system. I have made several improvements over the years as well. One I already showed you, changing my position size to be a little bit bigger because I'm using a 50% stop. I use that on every trade. I use the findings that I showed you how I go about that with finding the most efficient strategy and most efficient strike and expiration. And then I work hard at sticking with the winners as long as they continue to trend. Another big improvement was using alerts. When I see a pattern in a chart, but it hasn't triggered yet, I need to always remember to program an alert at that key level so that it gets my attention. Even if I'm not looking at the chart, it gets my attention when that level is broken. And then I share with you the top-down market analysis. So those are primary improvements I've made over the years. My primary edge is coming from technical analysis, which is based on the charts. And I'm just using simple trend lines or support and resistance. The key thing of my swing trading is I'm a trend follower, and I'm either looking for breakouts of a new trend or resumption of an existing trend, because I believe those are higher odds behaviors. My objective is to keep losses small and let winners run. My risk per position is no more than 2% of my account. Now, I certainly can trade smaller than that, and I have occasionally in very volatile markets, but never more than that. And then that 2% risk rule, I can show you how it used. I already showed you how it used 4% of my capital, but it's still only risking 2% of my account value. And then I have a portfolio risk where I have no more than 6% account at risk with the initial risk of any open position. Yes, I can have more than 3 positions on at once, only if one or more of those open positions, I've already moved the trailing stop to a break even. Then I have initial risk available for another 2% position. I do roll positions at expiration, but it's only on the strongest winners. I never roll a loser. I'll get out and back in on a loser to see if it turns into a winner when the charts and conditions are right. The other key thing I do is I try to always have both bullish and bearish positions in my portfolio. However, I adjust the percentage of how many open positions are bearish versus bullish based on the overall market condition. This drives what am I looking for the next position, bullish or bearish. It does not drive how do I manage or get out of an open position. So this is a portfolio management rule. The first year of doing this type of trading was the worst performance, but it was still pretty respectable. The first year I did 68 trades, 35 were winners, 33 were losers. The average winner was $3,000. The average loser was $1,000. So already you kind of see a 3-to-1 ratio there. The biggest string of losers was 5 losers in a row, and the maximum drawdown was 6.6%. That year I started with a $50,000 account and ended with $124,000. That was the worst year of this trading method, and I never risked more than 2% with any one trade. My performance has gotten better than this over the years, where I've slowly made improvements, of which I already highlighted some of those, and they impacted my overall performance. This is a scatter graph, and on the left you see the losers, and there was no loser that year greater than a -1R. The average of all the losers was a -0.6R. On the right, you see all the winners with an R multiple. There were some winners that almost were a 6R multiple. There were some winners that were less than a 0.2R, but the average of all the winners is 2.0R. So obviously that's bigger than the losers. So if you average all trades out, that's as if I earned a 0.7R positive profit on every trade. That's the average. Over the 17 years, these numbers have changed, but they've changed in a constructive way, I believe. The average losers have grown a little bit from a -0.6 to a -0.7 to a -0.8R. And the most that I've ever had go against me in a year was a position could gap against me overnight, but that's never happened more than once a year. And so if I have one trade that's bigger than a 1 hour loss, that's not a problem because the average was still in the 0.7, 0.8 hour loss range. The average winners have grown over the years to 2 to 2.5 to 3 to 3.5. I've already this year had 2 or 3 trades that were a plus 0.6 R. And this has been certainly a volatile year. The net effect is this is a positive expectancy and has improved over the years. What is my daily process? Okay, we're kind of running low on time. I'm about 75% of the way through this. Want me to keep going? I'm happy to do so if you don't mind hanging out.
Keep going, Carl.
Okay, I will. Sorry, I pick up the pace a little bit. Okay, so basically my process each day is pretty simple. Identify opportunities with the top-down process, which I shared with you. I've learned and built up my technical analysis skills by first recognizing high odds chart patterns after the fact, after they've already completed. And that's how you begin learning, with lots of practice. But that's not the skill that matters with trading. What you need to do is take that to the next level to learn to visualize in your mind these patterns as they're forming, but before they break out and occur. So, and we'll see some examples of that in a few minutes here. So this is where my key edge comes in overall in the long run, is implementing what I believe, and again, it's a belief, that from the technical analysis and high odds chart patterns, that I have a higher odds of that trend resuming than reversing. And we'll see examples in a few minutes. The next step is when I see an opportunity forming, I need to remember to program an alert at that key level. So when that price is touched, that alert goes off. I get a message on my cell phone. I go to my computer wherever I'm at, or if I have access, and pull up that chart and then make a decision to pull the trigger or not. So that's how, and implementing the alert made a huge difference with missing fewer valid opportunities. If I wasn't looking at the right place at the right time, I'd miss it. And then I don't want to go chasing it because the risk reward starts getting ugly. But using the alerts has made a marked improvement in the overall performance. Once that alerts trigger, I'm looking at the chart and making my decision. Are my criteria met? Is it still valid? Then if it is, I set up and place my order per the position size that respects my risk management rules. Now with the open positions, I'm managing the stop. There's an initial stop. And if it's hit, I'm out. No questions asked. Or if it's not hit and the trend shows sign of continuing for a while, if it's moved enough, I'll move my stop. I don't move my stop more than once a day. And then when the trend shows sign of ending, I'm out, okay? So I'm just capturing the move, the momentum. That's my, that's the prey I'm seeking. So let's look at a couple recent trades from this year that I believe are very good examples of a couple things, but they're actually pretty close to what my average loser and average winner looks like. I don't want to show you my best trade of the year or worst trade of the year. Actually, I don't mind showing you my worst trade of the year, but I think it's more meaningful and realistic to show you here's something that's very close to my average winner, and here's something that's very close example of my average loser. So here we're looking at in the second week of January in the energy sector, and I drew a line on the high from last October at 35.75. And I programmed an alert there because because the last 2 or 3 weeks, we see a rally that did not get there, but it's getting close, isn't it? So I programmed an alert, says, hey, ring me up, let me know when it gets there. Okay. So that's the line you see drawn there at that level, okay? The next day, it got closer, but it did not trigger. It came close to that alert, but it did not trigger. The next day, it triggered. In fact, it triggered right at the open. I got an alert right at the open, and within a minute or two, I was looking at the chart, and I say, yeah, it's valid. So I pulled the trigger. I bought 20 calls of the 35 strike Feb expiration, and I paid $280 for those. My stop was right in this area here, the lows from the prior week. Okay. Okay, so 2 days later, I'm stopped out. My stop's triggered. I sold for $1.50. So that ended up equating to a 0.92 R loss. No problem. I stuck to my stop. I got out before. It's actually not quite 50%. I paid $280 and I sold it for $1.50. $1.40 would have been right at the 50% level. Okay, so the very next day it even dropped even lower. Well, I'm kind of relieved I didn't have to ride that pain train. The very next day it exploded and it passed above my trigger, which I had reset at the same spot. So the trigger went off actually midday on the 25th, and I bought the calls. The next day, it continued higher for 2, almost 3 weeks. And then it pulled back enough to hit my trigger to exit. So what I did on the 14th of February, because we're starting to get a little bit closer to expiration day on the 18th. So I sold 10 that morning, which pretty much gave me a free risk-free position, because you can see I paid less than $3. I paid $2.89, and selling half at $7, I paid for the whole position. But as the market sold off that day, later in the day, I sold another 5 contracts, and then the following day sold the last 5 contracts for $4.92. Oops. So that trade was a plus 2.3 R. Okay. Now, why I think this is a useful example is it shows another common attribute of trading trading technical patterns. One is the first time it broke out, it immediately failed and I got stopped out. That's okay. I reset the trigger, and the second time it broke out, it worked. So with this kind of pattern, you can call it whatever you want, but breakouts can fail, and they do fail. But when they fail, don't assume that, oh, gee, the gig is up, there's no opportunity, I'm going to just forget it and never look at this chart again. Don't do that. Realize that I see a pattern here. It's a bullish move. Oh, excuse me. Let me go back in time here. Wrong pattern. I see a bullish move, a bearish pullback, and then a resumption of the move. So that right there, wave 1 up, wave 2 down, and beginning wave 3 up, that's one of my continuation patterns. So I knew at that point, the second time it triggered, that odds were better than not for it to continue. And indeed it did. In fact, it made a move almost the same size as the prior 2 or 3 week move. So when you see a breakout and it fails, don't worry about it. It might still have some juice left. Keep it on your short list to keep looking at. Okay, let's give one more trade example of a bear market. This one was recent. And here, this is an example of the weakest sector on this day. And the weakest stock in the sector was NVIDIA in the semiconductor sector. Here's the NVIDIA chart back on April 20th last month. What do we see in this chart? Well, first we see support. So I drew a support line at that low on 2 or 3 days prior. and it actually extends to the left, and it was tested previously 2 or 3 times and respected. So I got that support really looks, feels, and acts like support around 210. We saw a bearish trend that gave back pretty much all the gains from March were given back in early April. So, and then we see a pause for 4, 5, 6 days. So again, this is a continuation pattern, one of my favorite patterns, where the trend is saying, we made a bearish move here, we paused, and odds when I see that in my mind, I know the odds are higher for continuation move. And what I mean by continuation, it's in the same direction as was the move prior to the pause. It's not the direction of this rally here, but it's the direction of the move just prior to the pause. What was the trend prior to the pause? That's the trend that's more likely to resume and continue. Now I blow up into a 5-minute chart here. The same conditions where on the very next day, we see a lower high. So we see a high back on Thursday 2 weeks ago, and then we saw a lower high. NVIDIA I've traded for many years, but its behavior is it tends to make a crazy move at the open, and then more times than not reverses it. So we see an opening high back here 2 or 3 weeks, a couple weeks ago. So we see this behavior back here at this high, and then we see it again at this high, where it gaps up and then immediately reverses and fills the gap. And we see it again the third time. And I'm comparing the high of each one of those highs, and each one of those highs is lower than one prior. So to me, in the world of technical analysis, that gets my attention because I know the odds are pretty good for not only to fill the gap after the open, because that's how crazy this thing often acts, but also if it resumes the trend and breaks support, then I have a pretty good trade on my hands. Well, one strategy is to wait for support to be broken here and trade it down at that point. So that's a valid entry point to get short. I was being more aggressive and I actually got short here. So let's go and see how this trade played out. So the entry was on the 21st. In the first half hour of trading, I bought 6 of the 220 puts. And at the time, NVIDIA was trading at 217.75, and the implied volatility on those puts was 0.58. Then the very following day, on the opening move where it gapped down and made a wild move down, I sold 2 of those 6 contracts for 199. A nice, reasonable little gain, because I understood the wild nature of the opening moves on this particular stock. Later that same day, as it broke down and continued lower, I sold 1 more contract. I sold 1 more contract at the at 65.50, and the reason why I did that was the premium, the money I collected by selling these 3 options, 2 in the morning and 1 in the afternoon, was it paid for 100% of the cost of this position. So the other half was risk-free. I call it risk-free as with tongue in cheek, because I paid 100% for the cost of this, plus actually booked a tiny bit of profit. And the other 3 are unrealized profits that have the potential for gains. And you can say I sold the last 3 on the following, I think it was Monday. Yeah, on the following Monday for $28. So the net after selling all 6 of those puts was the net return was a plus 2.8 R. The reason why I chose this example was to also point out that implied volatility, even though I'm buying long puts, the nice thing about bearish moves and puts is not only delta improving the value of those puts, but Vega is also dramatically improving them too, as implied volatility grows as this trend moves lower. So I look at puts as a double win in a bearish market because of that. So let's review what we've kind of gone over today. I'm going to wrap this up as quickly as I can. Is understand and know what your beliefs are and build a system around that. Know what your edge is, really understand it, quantify it, identify it, and capitalize on it. And develop, and most importantly, have a written document that is your trading plan, a systematic process that fits you and your beliefs. Then collect data, analyze the data, and continuously improve your processes or your tools or your efficiency. Optimize the options efficiency, strategy, strike, and expiration decisions to fit your objectives and opinions. Be consistent with your decision-making processes. You're not going to have consistent results unless you have a consistent process. And then focus on those factors that you have control over. The market does what the market does, but there's only a few things you get to do of choosing what to trade, when to get in, when to get out. So get good at those decisions. To wrap this up, this is my website, tradeobjectives.com. And each Saturday I publish a market observations, which is not based on options, but it's based on chart reading and developing chart reading skills and keeping it simple. And it's also structured as a top-down analysis. So if you're not sure how to begin or where to begin, read this several weeks in a row and you'll see what the process is for top-down market analysis and how I can identify where the odds are of how I can improve my performance. That's a free download each week at my website. There's also information at my website where I offer one-on-one coaching, and I've developed a couple different seminars or courses I've given, and past courses were videotaped or recorded, and I make available on DVD. There's what I call efficient options trading, which gets into much more detail some of the topics I covered today of how I analyze and optimize all of those decisions in far more detail. And then another course that I developed several years ago, I call a Trader Development Workshop. One of the valuable lessons I learned is I really needed to be disciplined and have a written plan and then measure myself to it and improve it. So this course, the Trader Development Workshop, really teaches the process to go through and develop your own personal trading written plan and how to do it in a way that fits you and your beliefs. I also have some custom indicators and a recommended book list, all kinds of resources at my website that are available for free. And then for being patient and sticking around with me today, I wanted to offer a discount on the DVD course where I'll knock $50 off of the DVD course on efficient options trading. So I'll make that offer available for 2 weeks or until the 20th of this month. If you have any questions about what's covered in the course, look at the page or so on my website to describe that, or send me an email if you have any questions, okay? Happy to answer questions. If you're interested in the course, send me an email and we can work out whatever payment, and shipment, and so forth. The Trader Development Workshop, that course normally goes for $7.95. I'll knock 50% off of that course, and that's good for the attendees today until the 20th of this month as well. Again, details of what's covered in that course is at my website, and I appreciate you sticking around. I'd like to answer. I'm happy to stick around longer and answer any and all questions. My email is cjtrader@yahoo.com. So that's one way to ask me questions. Let's see if I can. I guess I need to stop sharing my.
Carl, I'll just tell you, we've got a couple questions in the chat.
Good.
So the first one is from Lindsay. It says, is the stop based on the chart or just the 50% stop loss you mentioned, or both?
Okay. Very good question. I like that kind of thinking. I tried to simplify things in my presentation today, but what I actually do is it's both. So if my the first condition is whatever I paid for those options, calls or puts, if they drop in value by 50%, I'm out of there.
50% of the premium that you paid for.
Yeah. So if I paid $4, if they're trading at $2, then I'm looking to get out. It's not automatic. I do not use a stop order because there's a lot of squishy nature of the options. Okay.
Yeah.
But the other method I use is I act as if I'm a stock trader, and I actually plot the daily trailing stop on my chart. And if that is triggered, then I either send myself an alert or I observe it when I'm checking on my open positions. And if, as a stock trader, the underlying went far enough against me, I'm out. Now, that probably happens a little more often than the 50% loss of premium. So a little bit more often, my exit on a losing trade or trade that's going against me is as if I was a stock trader, that trailing stop was hit. Therefore, I switch hats to an options trader and sell my options. And typically in that case, the options may have gone down and the loss might be a minus 0.6, minus 0.7, minus 0.8 R in that neighborhood. So more of my exits fall into that category.
Okay. Yeah, and so we had a related question for Robin. When you move your stop, you pick the stop price by technical analysis or by profit, and I think you kind of just alluded to that a little bit.
Yeah, generally it's like the prior days. If it's a strong trending stock, it's probably the prior day's low. But I also will study ATR and ATR multiples, average true range, and in the current market, maybe someone has a question in this aspect or not, but in the current market, I'm still trading the same way I always trade. But this year, I have a little bit greater focus on shorter term time frame charts because of the very high volatility and the almost daily reversal of trends.
Yeah.
So in this crazy market, I'm doing the same thing I always do, but I'm probably spending more time looking at a 15-minute chart than a daily chart.
Yeah.
And I'm doing about 10 to 12 trades a month, but those trades tend to average shorter duration because of the high volatility market we're in. So my trades so far this year are averaging 2 to 4 days. Yes, I've had a couple trades that last a couple weeks, but a lot of the trades are, I got in and out of a trade today on the queue I bought puts at the open and sold them a half hour before the close. That was a decent trade. But today was probably the widest or second widest range day of the year. So I was planning to hold it for a couple more days, but as today exposed itself as an extreme day, I said, I'm taking the money because high odds of it reversing tomorrow.
Okay, related question, I guess, from, whoops, it just popped off my screen. From Kieran, when you're planning your mental stops, what time frame do you use to look at the candles? So if you could talk about that a little bit, and I would add to that, personally, I would assume you're using a time frame similar to the expected time in trade or something like that.
Yeah, over the last 17, 18 years, my primary time frame for swing trading is daily. The daily chart has to prove to me I'm in a trend or there's an opportunity. Now, this year in the high volatility market the last few months, my execution has been on intraday charts and shorter time frame than normal.
Yeah.
And it's only so I love dynamic trading, meaning I adjust my parameters per the market. Okay.
Yeah.
So I'm doing the same thing, but it's kind of a shorter time frame.
Okay.
And yes, I like to take as much information from the chart as possible because it's not my opinion, it's fact. I don't have to agree with it or not, but if yesterday's low is there, today was a perfect example. Last week was a fantastic example. We had 2 failed rallies last week on Monday and on Thursday. Both of them hit similar areas of the highs. But the following day, they took out the lows and delivered new lows for the year. That happened last week on Tuesday after the Monday rally, and it happened last week on Friday and continued lower on Monday this week after making a failed. So those are failed rallies, and I talk about that in my weekly write-up. What did we have yesterday and today? Another failed rally. And the attributes of a failed rally is, and in a bear market especially, we have a violent rally. So yesterday, the last 80 minutes of the session, it just took off like a rocket. I'm saying, what are the algos doing here? But what happened today? We not only gave it all back, but we delivered new lows for the year on the second widest trading range day of the year.
Yeah.
Or the biggest range day of the year for the Dow. So those are attributes of a bear market. And in a bear market, I sell the rips. In a bull market, I buy the dips. Okay.
Okay, we have some more. So you guys says, so most just wants to confirm you mostly buy options with a delta of around 55 to 65.
Yes. And the only exception to that generally is if I'm hedging or buying a index. So occasionally 90%, 95% of my trades are with stocks, and you'd recognize all the names because they're the 100 most liquid stocks, the big boys. Okay.
Yeah.
Occasionally a few of my trades like today was with an index. I was in a hurry. I didn't have time to decide who was the best stock to short. I got short the Qs because I know the NASDAQ was making the bigger moves up and down over the last weeks.
Okay. Yeah.
So occasionally I trade the SPY and the QQQ. When I trade those instruments, I'm generally buying right at the money. So today I bought at the money, or actually, let's say today's trade in the Qs, I bought, they were 30 cents in the money when I bought them. Okay. I bought the 325 puts just a minute or two after the open. And then I sold half of them about 36 minutes before the close. And the other half I sold about 25 minutes before the close today. I very rarely day trade options because the slippage makes them very inefficient most of the time. But today was an exceptionally high volatility day with an exceptional move. And by the end of the day, I already knew that we at least had the second biggest move of the year.
Yeah.
So in that case, I'm going to be much more aggressive at taking the money off the table. Okay. That's a rare event. So yes, occasionally I'll day trade options, but that's usually an inefficient strategy unless you have a crazy day like we just had.
All right, we have a few more. I'm going to skip around a little bit because it's a follow-up here. Serge says, have you considered trading debit spreads instead of long calls or puts? Apparently they offer better risk-reward ratio.
Well, with spreads, regardless of whether they're credit or debit, yes, I've traded them all. I've traded everything under the book, okay? And then some. I've created some crazy things too. with a spread, you're limiting your reward and you're limiting your risk. And there's nothing wrong with that. If you're comfortable and that meets your objectives, that's great, because you can structure them with pretty high odds. What I have found is I do far better because I don't limit my rewards, but I do limit my risk. And that's just a personal choice thing. Not everyone's cut out to be crazy like me, okay? But what happens is, and you saw it on the scatter graph that I shared earlier today, is that there's a whole distribution of winners, small winners, medium winners, big winners. And out of that distribution, there's an average. But what really makes your year are the best 1 or 2 trades. And I almost every year, I at least have one trade that does better than 10R.
Yeah.
And this year's a different year so far. I've not had any 10Rs, but I had a 6R in January. I had a 6R in February, and I had a 6R in March. And I had a 5R in April. So just those are probably the best trades of each month. And there's about 10 to 12 trades each month. But, you know, at the end of the year, the averages really, I make damn good money, and I've done this for 20 years. And some people don't believe it. And then, yeah, so you go through an audit and show every trade, yada, yada, yada. But for me, that suits me. I don't want to limit my rewards. Now, there are times where I do vertical spreads, both credit and debit, but those tend to be rare occasions.
Okay.
And it's just a choice. There's nothing right or wrong. It's just a choice.
Right. Kind of combine 2 questions here. First, from Lindsay says, how are you monitoring your trades? Do you use alerts, or are you watching the market during the open? And to combine that maybe with Kieran's question, can you go over your Oxy chart again and explain how you plan to get out for a loss? Maybe those 2 are related. If you could do that.
Yeah, sure. Let me see if I can navigate to, well, I showed 2 different trades. You want me to go back to the losing trade?
The one in Oxy.
The losing trade or the winning trade?
That was the first one. Yeah, I think it was
the first one. Sure.
Yeah.
Okay, so that was this trade here. Am I still sharing? Yeah, I'm still sharing my screen. Okay. So what was the question again? It was, how did I win and how did I get out? Or
explain how you plan to get out for a loss. And related, I guess, was Lindsay's question. Are you watching during the market when the market's open all the time, or are you using alerts primarily to
okay. Okay, let me answer each of those questions. My trading styles changed over the years. I actually day traded for several years the futures and did pretty well, and sent 3 kids through private university doing that. But that's a high intensity, demanding activity. As a lifestyle change, and as I got older, and as I got more efficient with options, I gave up that that trading style, but I had continued the options trading all along. And one of the reasons I've chosen to trade the style I trade is I don't have to be stuck to the screen all day long. Yes. Now, for some people, you like that. Some people can't. Some people have a job that you need to find a trading style that fits your lifestyle. Okay. So for me, I've chosen to enjoy life, and I, on average, spend typically the first hour and last hour of the session each day at my screen. And then during the day, I'm probably off doing something else, with the exception of days like today, when things get, or yesterday. So yesterday, I certainly knew that the FMOC meeting was at 11 a.m. Pacific time. So I was at my screen just before that, and I enjoyed watching the crazy tape that followed. I did not trade it, but I enjoyed watching it because it refreshed my scalping and day trading skills without actually trading. Today was also a very different day too. I was I came and went, came and went, came and went, but probably 50 to 60% of the day I was at my screen because things were, oh, that support didn't hold, that broke. Oh, that support broke. Okay. So each day's different. But what I like about my trading style is normally, a few minutes at the open, a few minutes at the close takes care of most trades and most days. And then when the alert goes off, then whatever I'm doing, I can drop what I'm doing, or sometimes maybe not, but I can get to my screen and address it if it needs to. Now, sometimes the alert is a new opportunity that I'm considering getting into. Other times, the alert is, up, your stop is about to be hit. So I programmed an alert where I thought support, where my trailing stop was. And I may change that alert each day, no more than once a day. And if it's a trailing stop, only in my favor. I don't move it if it's gone against me. The initial stop stays there until I'm stopped out. But if the trade works in my favor and it works enough, then I'll move the trailing stop once a day. So if that trailing stop or that initial stop, now in the case of Oxy, that was an initial stop that got hit a day or two after my entry. So the entry was triggered on the 18th of January. I programmed my stop near the lows of the 2 or 3 days prior in the 34 area. The next day went against me, but not far enough to trigger my stop. That was on the 20th. Okay. On the 21st, my stop did get triggered because it hit around that 34 level. I don't know if you can see on my stock chart.
We do.
That my stop was near the lows of these 3 days. And on this day, it got triggered. And this was on the 21st. So that alert went off. I was not on my computer, but I got there in less than a minute. Okay. And then I saw, oh, this is not looking good. Time to get out. So I got out a few minutes later, and I was able to get $1.50 for those calls. So that's how that activity transpired, and that's typical. So because I am comfortable to walk away from my screen, part of what makes that comfortable is knowing I've got alerts that worst case something happens crazy. There's some news that a plane flies into a building in New York City, whatever happens, I'm going to know about it. And if I need to take action, take action. Okay. Hopefully that answers the question.
Yeah, and that's generally my approach as well, is get some alerts and then go get on with your life, unless the alerts go off. And that works pretty well if you can do it that way.
Yeah, so for me, on the average day is 30 to 60 minutes in the morning. Actually, I look at the markets before the open, but basically most of my trades fall into the opening half hour and the closing half hour. But there's trades that can happen any time of the day when alerts trigger or something else happens.
Yeah. Okay, let's see. Kieran asked me if the recording will be available. Yes, it's being recorded. It will be available at Aramir in the library section. You might have seen that when you log in. There's those tabs up at the top or whatever. Go to the library section and it'll say Roundtable with Carl Jorgensen. It usually doesn't appear for a few hours. Certainly by tomorrow it should be there. That's because he has to do a little processing to get it posted, but it's there and you can watch it there. I don't think it'll let you download it, but for those who have just joined Aramir, maybe I can ask Tom if he can let this one be downloaded if you'd like to do that. But it's going to be big because we're going almost 2 hours.
Yeah, I apologize for going long, but I'm happy to stick around to answer all questions. So
yeah, and then let's see, we got a couple more. Let's see here. From Kieran again. What is the minimum DTE by options following the trend? And do you use the VIX or individual stock options to decide on the DTE? I'm not sure. Anyway, if you can comment on that DTE.
Okay, so it's basically selecting the expiration series. Okay. I call it series because we have tons of strikes available at each series. And as you probably have well known, is that over the last 10, 12 years, weekly options have become more available. And even with the major indexes, there's even daily expirations. Tons of choices, which I'm not real happy about. That's a whole nother story. So what I use is, what is my trading style? And as if I was a stock trader, if I'm following the charts, I say, this is a good chart to get in. And if I was a stock trader, that's where I buy it and that's where I get out. So having done many trades and kind of analyzing it from a technical analysis standpoint, I have found from experience. Now, if you're brand new and just starting off, then you're going to have to do some either paper trading or some tiny account size trading to find out what is your trading style and what is your average holding period. So as I found I think I shared a chart of my first year performance. The average holding period on that first year was 5.3 days. How do I know that? Because I kept track. I set up a spreadsheet to keep track of the date and time of entry, date and time of exit, and then the spreadsheet does the math. And I just average, the 60 trades or how many trades that was that year, and it tells me, okay? So knowing that is useful for this purpose to say, if my average is 1 week, but I often enough have a holding period of 2 weeks, then maybe I want to go out at least 2 weeks. I don't want to buy a whole lot more time because you end up spending a lot more money on extrinsic. And I'm trying to minimize extrinsic and focus on the intrinsic value of the options. So if I am lucky, and a couple times each year I get lucky, just dumb luck, but it happens, where I catch a monster trend. Now, when I get in, I have no idea that that's going to go as far as it's going to go. I don't know that at the moment I get in. I'm trading it like all trades, but I'm leaving that possibility open. And guess what? Yeah, 1 or 2 trades are going to turn into monsters. You don't know what they are until they do. So if they keep going and going and going, and I got expiration day rapidly approaching, that is never a problem. I got a stupid grin on my face because I'm looking forward to rolling it out to the next week or the next month on or just before options expiration day, because that's never a problem. Now, that only happens on a few winners, but I do that on the big winners or the strongest. So if I had, let's say I held a position for 2 weeks and it's expiration Friday, and the chart is not showing signs of stopping. So and let's say it's bullish and I have calls. Well, I'm going to sell those calls and turn around and buy a different month and different strike. And by doing so, I have a procedure. It's an exception in my rules. Now, I wasn't going to get into this because it gets a little bit complicated, but basically the methodology allows me to, hey, if you catch a monster, load the truck, buddy, buy a bunch. Now, I don't want to take on more risk doing that. So what happens is, and I cover this in my efficient options trading course on the last DVD, as I was answering questions and giving examples of an actual trade. But if I have a winning trade, it's expiration Friday, I'm going to roll it into the next week or month or 2 weeks out or a month out, whatever is appropriate for that series, to keep riding that trend. But I'm not going to take 100% of the dollars that I just made on the first trade and risk it on the second trade. If I did, I'd have a huge position that actually violates my risk rules. But it's house money. Well, if you want to do that, fine. I don't want to do that, because the day after I do that, it might reverse and take it all back, and I can lose all of that profit from the first trade in the second trade. So what I do, and this again, this is a personal decision of what are you comfortable with your risk. I'm sharing what I do, but this may not fit you in your risk comfort level. What I do is I say, all right, I'm going to book 20% or 25% or 50% of the profits from the first trade and use the remainder to pay for the next roll trade. And there are times where that second trade is actually bigger than what my normal 2% risk rules would allow. And that's okay. That's the only time I ever put on a position that's bigger than what my 2% rules are. And it's paid 100% with profits from a winning trade. But I'm not risking all my profits from the first trade.
Right.
I'm using a ratio. So let's say half the profits, let's say I risked $1,000 and I made $6,000 of profit. Well, maybe I keep half of that and take $1,500 or $3,000 of the profit into the next position. Well, that's probably bigger than my normal 1% risk. It's 3 times that. But that's profit that I'm risking, not initial risk that I'm risking.
Right.
Occasionally, like on average once a year, I'll have a trade that I roll more than once. And yes, if you compound the returns from that first trade by adding the profits from the second and even third, when you catch a monster trend, again, you don't know it until after the fact. But yes, I've realized 10 and 12-hour returns on a trade because of that. And those make monster years for you because they weigh very heavily on that distribution of winners for the year and make a big impact. So that's how I choose to leave open the possibility for 1 or 2 monster winners each year without increasing my risk doing so. And that's the concept that's important to me and to teach. Okay, I found a way to roll with it when you're lucky, but only a couple trades a year meet that criteria.
Yeah, and that makes sense.
I hope you followed along with that logic.
Yeah, basically do it without adding risk or reducing risk, basically.
Yeah, so I'm taking a portion of the profits, not 100%, but a portion, maybe 75%, maybe 50%, and risking that in the second rolled position.
Yeah. Okay, I think we got through all the questions, so I guess this might be a good time to stop. Very good session, Carl. I really appreciate you coming on.
I'm probably very different than most traders, and that's okay. Good exposure. Hopefully, I've gotten people to think about some things, and I'm not here to change or impact your trading style, but I am here to encourage you to do some analysis. I showed you examples of analysis I've done to say, hey, am I getting the biggest bang for my buck of each dollar risked? And how can I improve that?
Yeah.
That's the important thing. Hopefully I communicated. Okay.
Yeah. Okay. Well,
well, thanks for staying late. I apologize. We ran way over, but hopefully you found this valuable and useful.
Well, I certainly did. And we'll check out your website, Carl. And yeah, we'll go from there. Again, everybody, look for the recording not later than tomorrow. You should see it in there. And if it's not in there by tomorrow, I'll be calling Tom and ask him to get it in there. So you can review all this and make notes. And
yeah, my email is there. Feel free to send me a question if you have questions.
Yes. And AirMirror is there's a lot of us traders here out on AirMirror, primarily income traders, but a number of people that trade longs and like you do as well. And lots of sessions that you can see in the library. And
super. Yeah.
Well,
and hopefully people don't take this wrongly, where no, I'm not against premium selling. No, But I am very much for understanding the pros and cons of any and every strategy you do use and manage it wisely and carefully, knowing so.
Yeah. Yeah.
That's my message.
Yeah. No issues. Yeah.
Okay, super. Well, thank you again for the opportunity. I'll stop sharing my chart here, and you've got my email if folks have questions.
Okay. All right. And everybody, we'll see you all later. Thank you for joining, and trade safely.